All right. Well, hello and good morning, and welcome to what's actually now our eighth Simply Tax Talks. It's the conversations continue to evolve. We're getting closer and closer to the end of the year, and basically we're still kind of in the same spot, talking through the latest developments, what's happening in Washington, what we're hearing, and also sharing some of the insights on maybe what you should be thinking about as we kind of head into the end of the home stretch of 2021. We've been getting a lot of questions. I know I personally have been having a lot of conversations around year-end planning, which I always say is my favorite time of year. I enjoy very much getting to sit down and talk through and hear what's going on, and also help with some planning tips. And so today we're going to sprinkle some of those in as well. And probably before I bring Yelena and Ted on, just to maybe a quick plug, and it's because I know Yelena might not do it. Our last episode of the podcast, episode 135. We talked about our year-end tax advisor, which is a publication that we have at BKD of 20 or so, actually more articles around helping you with year-end tax planning. And it's something that Yelena is very much involved in, and actually wrote an article on as well, and was in the episode. So if you haven't already, check out episode 135 and give it a listen, because there's a lot there. But I guess with that, why don't we jump into our top tax topics for the day and bring in Yelena and Tad. All right, Yelena, Tad, welcome back. Again, we always said we just kind of have a lively conversation, I guess, if that's well, and follow this thing where it goes. And here we are back, again, kind of back to figuring out what's going on. So maybe, Yelena, we'll start with you today on the question that's become the recurring one. What's up with the BBB? And probably, I guess the second part here is, will we have a BBB Christmas? I guess we'll call it.
Well, it is, to keep the acronyms going, TBD, because we've all been waiting for the Senate to release something, right? They've been negotiating for almost a month now since the House passed their version of the Build Back Better Act. And on Saturday, the Senate Finance Committee finally released their version, which was like a little over 1,000 pages. It's a little underwhelming because we expected them to make material changes just based on the press conferences and the quotes we've been seeing in negotiations, but it's kind of underwhelming, honestly. They made some technical changes just to comply with the budget reconciliation rules in the Senate. But as far as policy changes, there wasn't that many material changes like we expected. So it doesn't include Wyden's billionaires tax, which is the mark-to-market policy. And Wyden said that he's going to continue to try to get that in there. So it doesn't mean that it won't make it in there in the final version. But the current version that's been released by the Senate does not have that in there. They also put a placeholder, literally it says placeholder, for the SALT solution. So that's still being negotiated. And the Senate said that as soon as they reach an agreement, they'll put that in there. So that's currently also TBD. And then there's a couple other small changes. For example, they took out the vaping tax on e-cigarettes. There are some arguments made for policy, whether you want to raise taxes on e-cigarettes, but not regular cigarettes. Mm-hmm. And so due to some negotiations there, that got taken out from the House version. The international provisions got changed a little bit. There's stricter rules concerning inversions under Section 7874. And then there's actually some taxpayer-friendly changes under Section 245A dividends, which this section now provides partial deduction for 10% owned foreign corporations. And then 163N interest expense deduction limitation changes also, which are more taxpayer-friendly. The updated text will probably be still changed for a couple reasons. One, it's not complete. We don't have a SALT solution yet. And two, the Democrats are still negotiating several of the provisions. Some of it's technical, some of it's policy. So mostly technical. They're working with the Senate parliamentarian they're called bird bath meetings. But basically the parliamentarian vets the legislation to make sure the text complies with budget reconciliation rules. So any provisions in a reconciliation bill must have a budget rather than a policy impact, and it can't add to the deficit outside a 10-year budget window. So remember, the Senate Democrats are using the budget reconciliation process to pass this bill. And the benefit of this is they only need 50 votes, which means every Democrat has to vote. And so to use this process instead of the regular bill passage process, they have to meet all these procedural rules, which the parliamentarian is in meetings to just basically double, triple check that. And a lot of the changes that arose in the Senate Finance Committee version was because of that. The Senate Majority Leader Schumer has said that there's about 20 more issues they're vetting and litigating, it's his word, with the Senate parliamentarian, if they can include it in there or not. And so we'll see what comes out of there. But as far as timing, there is some pressure now. Well, there was pressure, but increased pressure because the IRS told Congress that if they want to see the January 15th child tax credit payments go out on time, then they need to pass something extending the child tax credit by December 28th at the latest to give the IRS time to, I think it's like 60 million payments that need to go out. So the Senate Democrats said they're trying to see if the IRS will give them a few more days. But that is just some additional new information that we've gotten this week.
Yeah.
I just throw in the two. With Elena, I mean, we were waiting for this thing to come out on Friday because the finance committee, chairman said on Thursday that he'd have it out Friday. Nothing came out Saturday mid-afternoon. And, when I pulled it up, I thought I was still looking at the House bill. And again, we were very surprised that, there was really nothing in there. The most I could find is they changed the funding buckets for the IRS, on the additional funding they were getting to them. So a little disappointing from that aspect. But as you kind of talk to people, that I still think this is going to change. I think this is kind of a larger placeholder that's out there. So I still think there's going to be some of those tax provisions in there that may change. But, we shall see what will happen. But again, the whole problem is it's going to have to go back to the House. So the Senate's really not only trying to placate, all the 50 senators they need, they really have to kind of take the House into account if they got to go back to them too.
Yeah. And I'm looking over here because we've got the poll going on, and maybe we'll keep it up a little longer here because we'll get into maybe, I'm gonna coin this. I'm gonna save you singing like the Elvis Presley version of Blue Christmas, and we'll just leave it with BBB Christmas there, and let your imagination fill in the rest, I guess. But
the good news to that is that if they keep it the way it is, there's not going to be a lot of reading to do because we've already.
That's true. Actually, yeah, we were chatting about that because it's always, I feel a little conflicted, right? Would I rather it happen before or after? Because I mean, if it slips into January, that makes the tax season a little bit more challenging because that probably delays things. But do we want to read a bunch of new pages? Well, to your point, Tad, it looks very similar to the House version. So maybe that's a point in the momentum column, I guess, versus the headwind column for whether or not we'll see BBB Christmas here. But I know, Elena, and we've talked a lot too about Senator Manchin in particular. Obviously, there's others that we kind of align things, and again, Tad, you alluded to it as well. But what's happened with Senator Manchin, and what role will he play in, I guess, determining whether or not we're going to have a BBB Christmas here?
Well, Senator Manchin is continuing to be the kind of, I don't want to say one holdout, but throughout this entire negotiation process for months now, he's been kind of the voice, along with Senator Sinema, but Sinema has kind of backed off once her demands have been made. So she hasn't been much of a concern lately, but Manchin, on the other hand, still has not publicly endorsed this legislation, which is problematic because, again, if you're using this budget reconciliation process, you need every one of the 50 Democrats to vote yes. So Manchin not supporting this publicly is kind of putting a damper on things. And he doesn't really have specific provisions he's against. It's more that he has concerns over the timing and whether we should be increasing government spending during a period of what appears to be spiking inflation. And so his thought process is, let's wait and see how inflation does, how the economy does, before we put more money into the economy through the spending bill. And so he's been in a series of meetings with Senate leadership. He's had calls with President Biden. And continues to have calls with President Biden and Senate leadership just because, again, this is a vote that you need to pass this. And without it, the BB won't make it out of the Senate. And so it's kind of continuing to negotiate. He's getting some pressure from Republicans as well to vote against this bill. Again, not necessarily maybe in general against the bill, but just the timing and waiting and seeing, maybe passing this sometime next year. But again, as we've talked about, there are so many issues with waiting to pass this because so many of the provisions are effective December 31st, 2021. So waiting would make a lot of this retroactive and require material changes. So it's kind of a balancing act. So we'll see what Manchin says this week. This is kind of the make it or break it week in a way, because the holidays are next week. So they want to pass it next week. They really need to get Manchin on board sooner than later.
Absolutely. Yeah. I don't know, Tad, any perspective you'd add on that one? Cause it's been kind of up in the air, but it sounds like at least there's no no's at this point in time.
I mean, the whole thing I look at here is, it is kind of odd that, the limelight or attention focuses on, Senator Manchin, where it could be any one of the 50,
Right.
that could hold off for any reason. But, so I'm not really sure how, he kind of rose to the fore on this thing, because I can't think that the other 49 are 100% on board with everything in this deal. But remember, I mean, we've only been focusing on the, the tax side of this BBB legislation. I mean, I printed out the tax piece of it. It's only like 400 pages of 1,100 pages. So there's something else, than there on the spending side. And I think that's what a lot of the, the consternation is. Like I said, on the tax side, there really isn't, a whole heck of a lot out here that, is going to have any real substantial effect on the mass of people. I mean, one of the things we'll talk about here in a little bit are some of the, I mean, obviously the SALT provision is a headline deal out here, but, there are some other things that are going on, around the SALT, at the state level that, may mitigate that somewhat. But I don't know. I mean, I think something will eventually get passed. I'm hoping that there are going to be some other more favorable provisions. I mean, look at it this way. We saw what came out of the House Ways and Means Committee, their initial pass, which the Senate Finance Committee is kind of akin to that. And you saw what changed between what came out of the Ways and Means Committee and what was actually passed by the House. I mean, it was light and day different. So we may have the same thing here, but given the timing, that's here. Look at it this way: the longer this thing goes out, the more that I think we're going to have the possibility of having some substantial changes to what was released on Saturday.
Agree. Yeah. More time to think about it. Maybe it seems like maybe that's part of the angle here of keep that momentum going. Maybe if they feel like they've got the conversation going, and particularly, I guess, with Senator Manchin, and if they're able to keep things moving, then let's keep it moving. But I guess in terms of the other item, I know, Yelena, last week we were talking as well about the debt ceiling and the debt limit. What's the latest there, and does that interplay here at all with our BBB Christmas conversation?
Yeah, so we've been talking about how the debt limit was set to expire. Originally, December 3rd is when they had passed it through. And then Treasury said, you know what, you actually have probably till December 15th before we worry about defaulting on our debt. And so obviously we're getting close to December 15th. And Republicans said, you know what, we're not going to support a debt limit increase. You've been doing everything on your own. Democrats, you can worry about this problem on your own. So everyone thought, that means the only option is pairing the debt ceiling with the reconciliation process. But last week, Democrats found some special loophole procedure that basically lets them increase a debt ceiling through a procedural method. And they only need 50 votes to do that. And so they're set to vote this week, probably maybe early next week, to raise the debt ceiling. And they're talking about increasing it to a level where it would be sufficient to last through midterm elections next year. And so as of now, everyone says that there's agreement and everything's on board. It's just a procedural technicality to get that voted and passed this week or early next week.
Okay. Yeah. Just one more thing on the agenda and things to be doing here. So it's, as we've said, it's a December to remember, I guess, in Congress. And there's definitely a lot of balls to be watching in the air. But, Ted, you kind of teed up a topic that I do want to get into. Or do you have something to add there? Sorry.
No, I just, I think we probably beat this thing up enough. I think it's just going to matter of, watch what happens the next week. I think what happens in the next week is going to dictate, I think, where we end up.
I think you're absolutely right. Yeah, it's well said in terms of what we're watching for here. So, well, let's switch over to our next segment, Tad's Takes, and get your take on the SALT area. So yeah, you kind of teed it up there a little bit, Tad, with mention around the SALT area. But I know I've been having a lot of conversations, in particular around that. Well, we'll see what happens with the BBB and the Senate and the I guess the TBD BBB on the provision, Elena. But these pass through entity workarounds that some of the states have. Maybe we talk some about that and how that's playing into the year-end planning this year.
Yeah, I mean, it's really something that is going to be very, very beneficial, but you really are going to have to do some analysis. So at this point, about 21 states, and that number keeps climbing, have adopted, some form of a SALT workaround is what they're being called. And basically this, applies more to pass-through entities, S corporations and partnerships. Well, at the heart of it, and each one's a little bit different, you got to look at the rules for each state, but at the heart of it, what they're doing is saying, look, normally the state income tax is paid on the individual return, individual partner's return, as opposed by the partnership itself. But what they're saying, and by doing so, that becomes an itemized deduction on the individual's income tax return, which is subject to the $10,000 limitation. Which, when you take a look at some of these pass-throughs, which are very, very profitable, I mean, there's a substantial amount of state income taxes paid by the individuals that they aren't getting a deduction for because of the cap. So the states are coming back and trying to do anything they can to help their people, because again, when they have the deduction for the state tax, basically the federal government is subsidizing some of that state income tax by giving the deduction to the individual. So they're coming back and saying, look, we're going to let you make an election at the partnership level, and the election is to let the partnership actually pay the income tax or be taxed on that income, and therefore it's not taxed to the or paid on the individual return for the partner. And the difference there is that now that tax paid by the partnership or the S corporation now becomes an ordinary deduction at the partnership level. IRS issued a revenue notice, I believe, back in 2020, where they actually authorized this and said, yeah, that's an okay ordinary income deduction. So the workaround is that, whatever your state income tax is, you're going to pay it at the partnership level, which reduces the amount of income that the partner pays tax on. So indirectly, the partner is getting a deduction for that state income tax. And that's a huge, huge item, for people who have, numerous pass-throughs. We've got some in our practice here where this is going to be a substantial benefit to, compared to what they've been dealing with, in the past, 3 or 4 years since TIC came out.
Yeah, it's meaningful. And maybe talk a little bit about the timing, I guess, and why it's so important, I guess, that we're having these conversations right now, and maybe some of the uncertainty.
Well, what we have are a couple of things, that we have is why I mentioned earlier about the analysis part of this thing, is that if you have a partnership and it only operates in one state, it's pretty much a no-brainer that you're going to make the election if your state allows it. Because you don't have any issues to be concerned with. You're just taking the tax, and as opposed to the partner writing a check for it, the partnership's going to write a check for it. So that's kind of a simple decision that you have in that situation. Now there is some concern about usually when the state set up these workarounds, the rate that they're having the partnership pay is generally the highest rate, individual rate, which, there may be some rate differential there, but I will tell you that, the benefit of having the deduction for the full amount is going to far outweigh, any 2 or 3% rate differential that you might have, on the tax that's being paid. Secondly, though, is if you have, partnerships or S corporations that operate in multiple states, multiple jurisdictions, you really do have to run some numbers on this, because, now without getting too technical on this, but, if your resident state's going to make you pay tax on your 100% of your income, whether it's taxed in another state or not, but they will give you a credit for the amount of taxes that you pay in that other state. And when in some of these workarounds, you are not going to get credit for that. So you effectively could get double taxed, as you go through this, and think that you're going to come out ahead by getting to deduct that. You effectively could be getting taxed twice, to 2 different states on that state income. So that's kind of the part of the issue. The second issue is watch the timing of when these things are effective. I'm in Colorado. We have a workaround, but it's not effective until January 1st of 22. So it's not effective, during this current year. So we really do have to look at it, on a state by state. The nice thing is that you can, you can look at it and do the calculations, kind of retroactively when you get the returns completed here in, April or whenever they're going to be done.
Yeah. The timing definitely can be an issue. Like I know in the state I'm sitting in right now in Illinois, there's a workaround that actually is effective in 21, but then there's some questions about, well, the timing of the payment and when does it have to happen? And maybe I guess there's a question on the federal deductibility as well on the timing. So running the math and doing the modeling is the name of the game, I think, for sure.
I would also put out there, one of our colleagues, Josh Wheeler, from our Nashville office, he's putting together, and it should be released here probably in the next week or so, a really nice table and matrix, that shows the states that have approved it at this point in time. There's 21 that have, and I think there are 3 more that have legislation out there considering it right now. But he's got a very nice table. He's got links to the actual, statute in there too, because you really are going to have to look at, each particular one, just because they are all different. They're all over the board about how you make the election. Whether if you make the election, it's effective for, all future years. I think there's only one state, I think it might be Connecticut, where the election once made is, irrevocable. But don't quote me on that. Check out Josh's work. But it does get to be a little bit, problematic out there. But again, it's, you're going to be in no worse situation. I mean, if you think you're going to get double taxed, just do what you were doing before. But I mean, it will provide a significant benefit to a number of the people out there, especially when a lot of these people that have the multiple pass-throughs, they're going to get, if this BBB passes, they're going to get dinged with, maybe the 5% surcharge or the surtax on amounts above 10 million, maybe the 3% above 25, and damn sure, the 3.8%, on the Medicare tax, or on the net investment income tax.
Yeah, I've done some interesting modeling there too, Ted, and just looking at the impact of, with and without if the BBB goes through, and then the layering in the pass-through entity election or the deductibility of the SALT piece. It really does change the numbers and make it a little bit more. I don't want to say it improves the picture. I guess we'll just say it. But again, not always, but in some cases when you're running the numbers,
it certainly does. And throw one other thing on there, and it's a little bit off topic, but not really. I mean, it's a change that's going to come in 2022, and that's the interest expense limitation calculation. I mean, a lot of people out there, are familiar with the Section 163J limitation on interest expense, which, basically is 30% of, call it your EBITDA, is what you're limited to on interest expense. But effective in 22, you don't get to add the depreciation and amortization back when you calculate, your base to apply the 30% to. That's going to be a huge item. I think in your state, where I think the National Association of Manufacturers are headquartered, they just came out with, how that is going to probably, disproportionately affect their members, because they're a very capital intensive industry. They've got a ton of depreciation out there, and they have to finance that stuff with notes and debt. And they're going to have some substantial interest expense limitations, just by nothing else happening other than the fact that they're changing the base on that in 22. So you combine that, the tax rate increases, and this SALT thing is actually maybe the only bone these people are getting thrown.
Yeah, the one favorable thing that we're kind of looking at as you talk through, but yeah, I mean, it really then you start to have to run the numbers on, well, do we do bonus depreciation? And again, we get 100% now. Next year we get 80%. And then like you said, as that ratchets off, and then you've got the business interest expense limitation. There's a lot of
the nice thing about the bonus, since it's both good for 21 and 22, you can actually retroactive plan on that thing.
Yeah, that's a good point.
When you do the returns, but it's going to be a bit of a difficult decision process. They're going to make. I don't think there's really a lot of real substantial, life or death decisions that need to be made before the end of the year. I mean, look, if you think you're going to be in a higher bracket, you think this BBB is going to pass. Yeah, you may want to push some expenses to next year, pull the income forward to this year. If you think you're going to be in those surtax brackets, you're going to be in no worse situation, if it doesn't. So, then you may have paid the tax a year early, but.
Yeah, I was going to ask your take on that, with the cash basis and do that. That's always the conventional wisdom, right? Is we want to, basically plan to defer the tax as long as possible, but obviously it flips it on its head if you think tax rates are going up. Like you said, if you're S corporation manufacturer, at the very least, probably looking at the 3.8% at the very least. So yeah,
Yeah, I mean,
that's
the way that
interesting.
I look at the thing is that you're in no worse position, by pushing it off, or you're delaying or pulling the income forward and, pushing the expenses off to next year. Even if nothing does pass and you're not in the higher brackets, you're not losing anything except, maybe a year earlier on when you're paying the tax.
Right. One last area I'll ask your take on for today. And again, make sure you get your questions in and what you're interested in. We had the poll in there about kind of what you're most closely watching. We want to make sure we're answering your questions at home, right? But Tad, one that I keep getting, and actually came up, one that we started to touch on last week, is choice of entity. And obviously we're still in an uncertain environment. So what's your take on that? And maybe looking at or needing to make decisions around choice of entity at this point in time?
It's a good question, but it's one that's very, very, I guess, individualized to the situation. A lot of it's going to depend upon, number one, how many pass-throughs you have, what kind of income. Look, if I've got somebody who has just a ton of pass-throughs and it's kicking that income up to the individual, above the 10 and the $25 million level, yeah, I'm going to look at it. But the other thing you got to consider is that, are they pulling any money out of the pass-through? That's the benefit of the pass-through, is that you can pull the money out of there without a second level of tax. So if they're pulling the money out, yeah, even though a corporate rate might be 21%, the individual might be pushing God who knows what anymore, close to 50, if all this stuff passes. By the time you take into account on a corporation, even though it's paying 21, you're going to pay another tax when you pull the money out, a double tax. So it isn't all that big of a difference. So I think a lot of it's going to come down to, does the owner of the entity want to pull the cash out of the business? I think that's going to be a big decision, about whether you do. But again, corporations are going to be, they're going to get another look at. I will assure you.
Yeah, I think so. And yeah. And I'll share up the slide that we have here. It kind of just shows the rates compared. Because again, I think you're right. There's no one size fits all. Kind of after the TCJA, that was a lot of the conversations, right? But yeah, the corp's going to get another look, and it becomes very interesting when you get the whether or not you have the qualified business income deduction layered in, and those surcharges, right? I mean, that's modified adjusted gross income. That's before the qualified business income deduction. So actually, those are more expensive than even kind of your regular rate, because you don't get that 20% deduction. So it becomes very, very interesting and challenging, I guess, too, because we don't yet know what's going to happen.
Yeah, I think that first row up there, the corporation, that's where, if you just read the headline, well, corps only paid 21%, but if you try to put it on a comparable basis about getting the cash out, it's actually, like I said, a 46.1% rate, comparable.
Yeah, and and this is for, I guess, for illustration purposes, the top rate, right? So we've got that 3.8 and all that layered on there, but yeah, we've got the it's part of a slide deck too overall. That if you want to email us, we can, if you want to take a little more look at that, at the simplytax@bkd.com, we can get you a copy of the deck as it's evolving here, and some of those comparables there. But it's it sounds like your take, Tad, is that there's no simple answer here, but you just got to crunch the numbers and go case by case. Fair enough to say?
I think that's fair enough, and honestly, I don't think it's something that you want to make some irrational decisions because you think you've only got 3 weeks left in the year.
Yeah.
I don't think that there's anything we've seen so far, and nothing that we're hearing that's going to require you to do something drastic here before the end of the year. So just kind of stay tuned, keep your ear to the to the ground, and see what's going, and keep watching us.
There you go. Right. Yeah. And we'll keep them going here as the conversation keeps going. Yeah. The one that, and actually, this is interesting. When I was in a planning meeting yesterday, Tad, and there's a trust, a certain type of trust, because it's an S corporation that owns the S corporation. So everything's been sort of living in this ESBT trust in terms of the income, and it's been paying the tax, and started having conversations around, well, does, looking at the trust, and can you make distributions, and do we maybe change the ownership, make a distribution from the trust of the ownership, things like that. I guess maybe that would be in the category, but again, the crystal ball is so uncertain. It's hard to know. It just becomes very interesting because those surcharges kick in so early for trusts that it can really it can be kind of eye-opening how much of a tax increase that can be. But to your point, I think a lot of times it's the 3.8 that most are going to be looking at. So it'll be interesting to see. But well, let's get our kind of our top takeaways from today before we wrap up. All right. I guess by now you two both know my question, my favorite question. What's your take? So we're going to call it a BBB Christmas here. We're going to have a BBB Christmas or not? Elaine, I'll start with you.
I don't know. I'm still on the fence. I think there's an argument made to say yes, because again, considering that a lot of provisions would be retroactive if they wait into January and February, I think everyone's just eager to get this done and get this passed before the year end. So it's possible. But then you also have, again, Senator Manchin holding out and saying, let's wait until next year and see how the economy does, how inflation does. And one person holding the things up is entirely possible. So I don't know. I think I'm 50-50 on whether this is a Christmas thing or not.
Okay. Tad, what's your, are you over or under the 50 here?
I don't think it's going to get done, this year. I think that there's going to be some, showmanship and some, drawing lines in the sand. So I'm at this point, I'm going to take the position that I don't think that it will get done.
Okay. All right. Well, there you have it.
Let me put it in an asterisk by that, and it's like, so what? I mean, I don't think it's really that big of a deal, whether it gets done, by December 31st or not by December 31st.
Sure.
Bottom line is we're going to have something at some point in time, and there's very little that was retroactive to 2021. So, it's like, fine.
Sure. You're getting let it slip into January. So you're low odds on before Christmas, but high odds on maybe January timeline or something like that. Fair enough.
That's fair.
Okay, Elena, what's so if you're on the fence, but then if it does slip, then what do you think the odds are when we get into January?
Oh, I think at that point you drag it out because everyone's working towards this magical Christmas deadline, and then once you take that off the table, it's almost like, okay, well, got all the time in the world.
Right.
Yeah, but factor in that you got elections in here too, and so people are just going to start campaigning, and ready to turn the calendar. So I think something will get done. I just am not that, thinking that's going to be before the end of the year.
Gotcha. Yeah, and not our if we haven't said enough, BBB Christmas over here. Almost said Blue Christmas, like the song. I don't know. Anyway, well, again, thanks all of you at home for joining us. We try to have a little bit of fun here. Get the hopefully got the caffeine going here and some coffee going along the way. But we'll be back again next week, same time, same place. In the meantime, email us at simplytax@bkd.com. Happy to share that chart that we showed earlier, or again, answer your questions or just be a resource as things are going along. But it's for sure going to be a busy week for the BBB. And I want to just say a big thanks to Elena and Tad for keeping us up to date here and giving us the take on what it means. So thanks again for listening, and we'll see you next week.